It finally happened. The stock market pulled back for the first time since October 2023, and speculative investments much higher up the risk curve, like Bitcoin, experienced a nasty correction in price. Now, even though we have recovered a bit since the market pullback, you're probably still wondering if buying the dip is always a good idea or if there are scenarios where you need to be more cautious. We'll talk about all of that, take a detailed look at each of my investments in ETFs, P2P Lending and crypto to see how they performed in April, as well as any important events you may have missed up until today, May 7th, 2024. I'll also give you an update on how my wife and I are currently investing our monthly savings in the current market environment. As usual, let's begin with stocks in the form of low-cost ETFs, making up the largest part of the investment portfolio I share with my wife. After going higher for 5 months in a row, something we haven't seen since 2021, we finally saw a long-awaited pullback in price, with the Vanguard FTSE Oval dropping 3.8% at one point and finishing April down 2.6% in euros. I'd argue this was a good reminder for all of us, but especially new investors, that markets don't just go up non-stop. You have to be able to deal with some volatility along the way, some of which can be quite rough to handle emotionally, even more so if you're looking at your portfolio all day. Then again, putting things into perspective, the FTSE Oval was still up 7.8% since the start of the year. Now looking at our ETF portfolio in actual numbers, it dropped about 7,800 euros in value in April, but just a week later, as of today, May 7th, it seems to have recovered most of the losses. That being said, we're not back to all-time highs just yet. Okay, now let's have a quick chat about buying the dip and if that's always a good idea. Here's the thing, buying the dip can be very risky with single stocks like Apple or Tesla, since you always run the risk that they might never reach and pass their previous highs again, as they could simply be replaced by other, more innovative companies. We've seen that happen time and time again. The same goes for very specific ETFs, which sometimes get way more hype than they deserve, where fund managers try to pick what they believe will be winning companies in the future. Meanwhile, you don't have that issue when buying the entire market via broad-based low-cost ETFs, like our favorite, the Vanguard FTSE All-World. A passive index like this is self-cleansing. You're ensuring that you're invested into all of the current and future winners, and less profitable, less innovative companies will have their allocation get smaller and smaller over time. They might even disappear into insignificance one day and drop out of the index entirely, while being replaced by stocks that are on the rise. Since you're buying the global market as a whole, which can never become worthless, unlike single stocks, and has historically proven itself to trend upwards over time and to significantly outpace inflation long term, buying the dip tends to be worthwhile when you have investable cash on hand. Once again, the same cannot be said for individual stocks, since you just never know if they're still going to be this relevant in a few years, a decade or more. So, if you were able to buy the most recent dip, congrats on locking in a discount on a few percentage points on your favorite ETF. Sadly, my wife and I ran out of investable cash before. Just to be clear, whenever I talk about buying the dip, I'm not suggesting you use money that you weren't planning to invest in the first place just because the market dropped. You should never touch your emergency fund, in our case a few months worth of living expenses, or other money that you weren't planning to invest long term, meaning for 5 years, ideally 10 years or more. Speaking of emergency funds, my wife and I still keep ours on Trade Republic, since they're paying 4% interest on euros secured by a bank deposit guarantee. These cash reserves earned us 69 euros in interest in April, and a 1% Saveback from the new Trade Republic card, which we are currently using for all of our expenses, earned us an extra 15 euros, which went into our favorite ETF in the beginning of May. By the way, you can find the best low-cost brokers in Europe, including Trade Republic, down below in the description, which is a great way to support me if you'd like to. And don't forget to subscribe if you haven't yet. Alright, let's continue with my investments in peer-to-peer lending. In April, I earned a total of 360 euros and 65 cents in interest on the 7 platforms I'm currently actively investing on, making this an excellent month overall. Here's how my money is currently distributed among them in percentage terms. Now let's take a look at each platform individually, starting with my largest one, Mintos. With over 89 euros in interest, April was my best month in over 3 years. At the start of May, I noticed that I had quite a bit of cash drag, since many loans from the best rated lending companies dropped below my 10% interest minimum. As a result, I decided to pick up my first 2 bonds by ID Finance and Utah a few days ago with an effective yield of around 12.5% per year, quarterly or semi-annual interest payments, and full bond repayments in 1 to 2 years. Next up is Esketit, which had a relatively weak month with close to 49 euros in earnings. I also see some cash drag occasionally, but it tends to resolve itself within a few days. The Jordanian lending company Money for Finance posted very strong financial results with a net profit of 4.2 million euros in 2023, which is great to see. At the end of April, its interest rate was lowered from 12 to 11% per year, most likely because there's still more demand than loan supply on Escatit. Meanwhile, I had another record-breaking month on VIA Invest with over 65 euros in interest payments. In line with the rest of the P2P market, VIA Invest lowered its interest rate slightly to 12%, so make sure you update your auto invest accordingly. With over 57 euros in earnings, Income Marketplace also had a great month with no cash drag. And there were once again zero problems on RoboCash, with everything performing as expected. Next, we have Lande, where interest payments were still a bit below expectations, but another one of my collateralized agricultural loans was fully repaid in April. And lastly, Debitum, which had another good month with no delayed payments. Alright, now let's have a look at the highest risk portion of my portfolio. My speculative investments in the two largest crypto assets, Bitcoin and Ethereum. What can I say? Last month was rough. While these can go up quickly, they also tend to drop a lot harder and more often compared to the stock market. In fact, last month I even mentioned that I wouldn't be surprised for them to cool off a bit after the halving, and that's exactly what happened in April. Bitcoin dropped 18%, lowering its 2024 performance to 40%, while Ethereum fell even more with minus 20%, with a year-to-date return of plus 31%. Even considering this crash in prices, these two are still currently my best performing investments in 2024. My experience in this high-risk sector since 2017 has taught me that you need to be able to stomach major corrections and crashes on a regular basis, and that they happen way more often than you may think, as you can see here. Luckily, they also recovered quite a bit over the past few days, so things are already looking better at the moment. Based off their past performance in market cycles, I remain very optimistic about Bitcoin and Ethereum until the end of the year. Just please don't forget that these carry a ton of risk, so if you decide to speculate on this sector, only do it with a small percentage of your portfolio, which is what I'm doing as well. Now, you may be wondering how my wife and I are investing our monthly savings in the current market environment. We tend to follow an 80-10-10 strategy, with 80% going into our ETF and the rest being split between P2P lending and crypto. But due to the occasional cash drag right now and interest rates dropping a bit across the P2P sector, we haven't been adding anything to our peer-to-peer portfolio lately. We're simply reinvesting interest we receive, which are still a couple hundred euros per month. What this means for last month is that we invested 80% of our funds into our FTSE All-World ETF and 20% into Bitcoin. Due to our above average income, our low expenses, and us being a lot closer to our financial goals than we ever could have anticipated at such a young age, you can find out more in this recent video. We do have a much higher risk tolerance compared to most people. So please keep that in mind and don't just blindly copy what we're doing, as your situation could be very different from ours. Alright, that's it for my investments. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to anything that I mentioned. And of course, none of what I mentioned today was meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.